Okay, so you like the idea of getting some income, right? By owning an asset, you'd like to have it periodically give you money, right? Give me money, give me some money, give me a payment for the privilege of owning this asset. And that's where dividend stocks and bonds really fit in this. So if you own a dividend stock, usually every quarter, some are monthly, but usually quarterly, based on the number of shares you own, the company will give you money, right? And you can really reinvest that money or whatever, or do whatever you want with the money, but it's basically free money that's coming to you. You can reinvest or go buy something with, go buy a boat, whatever you want to buy, right? So that's dividend stocks. And then bonds are basically debt instruments that like a government or issue, or a company or corporate bonds they'll issue, where you're basically buying a bond. You could be buying a bond exchange traded fund or something like that as well, where you get paid income by giving them, in effect, money is how a bond works. It's like you're the bank, you're giving them money. But for us as investors, you just think I invest in the bond or in the bond fund, they give me money, and then I can later sell my bond if I want to. But meantime, I'm still getting that regular income. And bonds will typically pay monthly. They can vary, but a lot of times they'll pay monthly, where dividends are typically quarterly. So which one's right for you? Let's look at that as far as the difference between dividend stocks and bonds and which might be right for you. By the way, in the description below, I have all sorts of courses. I have a special course just on dividend investing and just on bond investing, a lot of other courses too. Good sales, some free stuff and free courses as well. So do check that out. Okay, so let's talk about this. So which one's right for you? So let's look at each one from some factors like risk and return. So the classic risk and return to start with. So risk. So dividend stocks will tend to carry more risk than bonds. Just like stocks in general carry more risk than bonds in general. And then really when we're talking about risk, we're talking about volatility or prices going up and down. You buy in at this price and it goes up, great, you're making money, and goes down, you're losing money. So stocks have a wider range of price fluctuations than bonds do. That's really the idea behind risk there. So bonds are considered less risky than the stocks, and they're really what you're looking at for the bond is the creditworthiness of the issuer, right? So if it's the United States government, considered the gold standard, they're going to pay, they're going to pay your bond. You don't have to worry about the bond defaulting, because the government has taxing authority. If they need to pay their bonds, they just raise our taxes, right? Versus like a company bond or something where if a company goes bankrupt, you may not get paid your bond. Same thing, if a company gets paid and goes bankrupt, you're not going to get paid your dividend, and your stock might be worthless too. So see, more risk there. So more risk on dividends and less risk on bonds. But then the equation of the risk-return equation, you should be getting better returns on the dividends than bonds if they're more risky. And that's true. Dividends offer higher potential returns. They carry that higher risk, but not only do you get paid your income as far as the dividend, but you have price appreciation. As in, I buy the stock price at this price, and then the stock price goes up. That difference between what I bought in it and what I later maybe sell it at, that's all profit or capital appreciation. That's my profit. So not only do I buy a dividend, and while I'm holding it, I could hold it for years or as long as I want, and getting paid dividends all along the way, and maybe they increase their dividend, which is good too, because they can increase their dividends versus bonds that the dividend is set. I can also watch that stock price go up, and then if I want to cash out, get that profit as well too. So dividends stocks have a much higher, or have a higher potential for return. And thus bonds, being lower risk, have lower level risk and lower returns too. If you hold a bond till maturity, you basically get all your money back, your principal, but you don't get more than that. You get whatever you originally invested. That's if you hold it to maturity. Most people are buying and selling bonds, or if you're buying an exchange trade fund or mutual fund, they're constantly buying and selling bonds. You're mostly looking at the interest you're paying. But if you were to buy a bond that was, let's say, a 3-year bond, and at the end of 3 years, you get your money back and you've made all that interest, right? So that's great. If you buy a dividend stock in 3 years, same concept, you get all those dividends, assuming they didn't cut the dividend, and then you get and you could sell your stock, and you might sell it at a profit, and you might sell it at a loss too. So that's the difference between the two. And then if you look at income and duration, a couple other factors, both of them provide steady income streams, right? Whether it's a dividend payment or an interest payment. Bonds would be paying you interest. Typically, dividends are quarterly. There's a few that are monthly, but mostly they're quarterly. And not all stocks pay dividends, but the ones that do will typically pay every 3 months or quarterly. Bonds typically will pay you every monthly. So if you want that more frequent income, maybe a bond might be interesting too. And then duration in terms of, when does this all end? Whatever. Dividend stocks don't have a fixed duration. You can get paid dividends for as long as you hold the stock. I've got some stock I've held, for over 20 years or whatever. It's been a really good performer for me, and I've gotten dividends for 20 years every quarter like clockwork. Nice. Where bonds, on the other end, have a fixed duration, right? You hear them say it's a 90-day bond, or it's a 2-year bond, or it's a 30-year bond, or whatever the type of bond. What that means is that at the end of that term, it's all over, right? The bond is now done. It's done. It's done. You get your principal back, your money back, as I mentioned, and the term has ended. Where a stock can be more open-ended, and you basically decide when you want to sell it. So those are some key, quick things to look at when you're looking at bonds and dividends. I would certainly, what I do is I make complete online courses. I would say certainly check out the dividend and the bond courses I have in the description below. And I have a bundle, that I Want It All bundle, that gives you a whole bunch of courses for a very low price. So do check that out as well, because that way you get a lot of different investing stuff. Not only dividends and bonds and stocks and personal finance and real estate and lots of different stuff you'll learn if you want to check that out. So check out the courses in the description below. We got some free previews and all that as well. With that said, bonds and dividend stocks are great ways to get great regular income and a very strong bulwark of many investors' portfolio.